Papa Bear in the suit, Wall Street goes, teaching young cubs how to play the role.
And welcome back to Noobs. This is episode, technically I think this is episode 4. I took episode 3 down and got to rework some things in there with the audio. So this is technically episode 4. So today we are going to do some more earnings trades and we're going to manage our accounts. So let's go into, is this your account that's up currently? Yeah. Jaden, your account is up. So go to your positions tab. Okay. You have Google is still on. That was an earnings trade. Neo is still on. Neo is down overall. PLTR is still on and it's up overall. You're up $16 in there. You're up $100 in your overall account right here. Let's go to open up all of your positions so you can take a look at what's going on in them. You have 7,200 available in capital to trade. All right, so your PLTR position is, you've got the 24 strike put, it looks like. And the 20, what is that? The 36 call. That 36 call is not really doing you a whole lot of good. It's worth 14 cents and your long 41 call is worth 5 cents. So the difference is only 9 cents left on that side. So so go to the call, that call right there. Click on that call. The short 36 call. Then hit close selected. It should bring you to an options chain. Does it? No, it does not. Go back. Click on the call itself. Yep. Then go to these 3 dots over to the right of roll. Go show PLTR details. Did you click it? Mm-hmm. It should open up the chart. Okay, go to the options chain. And then go collapse this one. This is the wrong expiration. You have positions. See where you see the blue and the red flag right there? Or the green and the red flag, I'm sorry. Do you know what that means? It means you have an open position in this expiration, and it includes longs and shorts. If you only had longs, it would just be green. If you only had shorts, it would just be red. But your position includes the long and the short strike. So this is the short side. This still has juice in it. This is the put side rather. Go to the call side over here. Abraham, do you remember when you asked how to know when it's time to take a trade off? This right here is a good example. There's one of 2 ways that I usually use to determine whether or not you take a trade off. When we initially put this trade on, I don't remember what we took in for a credit, but it was probably closer to like maybe 40 or 50 cents or so. So we wouldn't be taking, what is this, $5 of risk from 36 to 41. That's $500 of risk. We wouldn't be taking and putting on a trade for the first time that paid us potentially $9 to take $500 in risk. We wouldn't take $500 in risk to make $9. So that means that if you wouldn't put this trade on today, then it's time to take the trade off. So one of the things, another way that you can do it is around 50%. So once it gets to 50% of the total credit that you take in, so if you take in 50, you make 25 of that 50, then you would be looking to take the trade off. Another thing that you can use is the time that the trade has left on. So around 3 weeks till expiration, which we're already past that point. 21 days left until expiration is 3 weeks. And I think we're at 18 days left until expiration. So if you're selling 45 days out in time, and we didn't sell that far out, but if you're selling 45 days, once you get to around 3 weeks, that's another indicator that it's time to start looking to take that off. Does that make sense? Okay. So back in your own words, how do we know when to take a trade off? I gave you 3 different things to look at.
How far away you are from the expiration date?
I can't hear you.
How far away you are from the expiration date?
Yep. Yeah. When is the ideal time to start looking? When should we start looking at our positions to say maybe it's time to manage this position? How many days left or how many weeks?
3.
Yes. Okay. Then what else?
50%.
50% of the max of the total credit that you initially took in. Sit up, please.
If you wouldn't buy it right now,
Speak louder.
you wouldn't buy it right now, where it is.
Can you speak louder?
You wouldn't buy it right now, where it is.
Thank you. That's much better. If you wouldn't put the position on for that amount of potential reward for the amount of risk. Yeah. All right. So we could close this, or because the other side is still working and still has about 60 cents left in it or something like that we can make out of it. It's trading at 68 and 6 cents or 10 or 7 cents. So yeah, there's still about 60 cents left on the other side. So what we can do, this stock has gone down. That's why the call side is winning and this bottom side isn't winning as much. So go back over to the call. What you can do is move your short. You can buy back this 14 cent or 13 cent call here. So hit the ask to buy it. And then go down or scroll down to like the 30 calls or something like that. The 31 calls or 30 calls. I'm at, yeah, up. All right. So these are trading for 80 cents and these are trading for 60 cents at 31s. So click on the 30 or the 31 sell. So we're buying back the one that we have and selling out this 31. Now, what is that going to do for our risk? How much money we're taking in risk now? What is that going to do to us? Go scroll back up so you can see your short call or your long call. I'm sorry. Your long call, scroll up. Remember, your long call is all the way up here at 41. So we had, how wide was this? From 41 to 36. $5 wide. If we take this and go from 36 all the way down to 31, then what do we have?
10.
Then we've got from 41 all the way down to 31. So now we're taking on more risk in order to do this. So you can do one of two things. You can leave that risk on there, but for a few cents, we can buy this back and then, or we can sell out of this one up here and buy this one right here. So it'll keep the $5 in risk. We're just moving our strike closer to the money to keep this side to have some potential to make money. You can close it or you can do that. Which of those do you want to do? Do you want to close that side or do you want to move it down? Move it down. So go ahead and click next. You can do this all in one trade or you can do it in 2 separate trades. This is the way we're doing it now is in 2 separate trades. So go ahead and hit review. See, you see how it says the buying power effect is going to be, what does that say? I can't read that. Was it $31? That's That should be more than that. I don't know why it only says it's going to take $31. Go ahead. Are we doing the right thing? We're taking in a max profit of max loss is 500. Yeah, I don't know why it's not causing more buying power. Go ahead and hit next. Okay. What just happened? It went through, right? There we go. Okay. Now click buy or sell out of this one. So click the sell on your long. No, the sell on your long. And then buy the 36. Next. It's saying it's going to cost you 8 cents. Okay. Send it. All right. You're filled. So now you've just basically moved your whole spread down. So go back out to your up or your positions tab. Now, Neo. This 5 call in Neo is only worth 9 cents right now. Originally, when we put it on, scroll over to the right, what did we sell this for? Sold it for 25 cents. So it's over 50%, and we're past the 3 week. So we can manage this Neo as well. So go ahead and click on the call. Go to the options chain. Hit it again. It didn't work.
What?
The show details. All right. It should bring up your chart. Go into options. All right. Now buy that back. Buy your 5 back. Then go to a different expiration. Go back up and shrink this expiration. And we're going to take it from 17 days all the way out to 52 days. You're going to sell the same exact call. We're just selling it again. Hit next. We're buying it for around 9 or 10 cents and selling for around 30 cents. So it should be around 20 bucks that you're going to take in again. Another 20 bucks. Hit review. Send it. Let that work. If it doesn't get filled, we might have to adjust it, but let that work. And now go to your other position, which is Google. This was an earnings trade that we put on. This one is not won. It's still a loser, but it came back a lot over the last day or two. So yeah, go ahead and collapse those. It was down. It was marking at around $2. It rallied up a few bucks here these last day or two. Now it's marking at less than $1 again, but you only sold it for 60 cents. Remember, you took in about 60 cents on this side and 40 cents on this side. This side right here, pretty much worthless. So you can leave that on or close that. That's up to you. But this side, we want to do something with this. So go ahead and click it and open up the options chain. And click the wrong thing. Go into details. Why does it take so long to go into details? It doesn't seem to, when you click it, it doesn't seem to do anything. Go to options. Again, same thing. We're at the 17-day mark. So let's take your put and we're going to buy it back. There's still good IV percentile in here, so it's still worth keeping this on. We just don't want to be in that cycle. So buy back this. It looks like you're going to be able to buy it back for about 95, 96 cents. Buy it back. And then go now out to the 50-day expiration like we were. This is after earnings now. So a lot of the volatility is probably out of this already. So, yep. Now go back up to around that strike. What strike is it? 160. See what you can get for keeping the same strike and taking it out. 160. All right. So you see how now this 160 out 50 days from now is trading at 265 or 264 around there. Now what you can do is take risk off the table and keep the same credit in if you take it down to the 155 or even the 150. So if you take it down to the 155, you're taking $500 of risk off the table, saying you're willing to buy it at 155, and you're taking in another about 65 or 70 cents in credit. Or if you'd rather not take in very much credit but take $1,000 in risk off the table, you could do the 150, or you could leave it at the same exact strike and take in another dollar 65 or so. Waiting on you. What do you want to do?
So, I don't know.
Do you want to have more risk on and be potentially willing to or able to make more, or do you want to have uh do you want to have the potential to make the same amount and take a lot of risk off, or somewhere in between there?
I want to take risk off.
Okay. So that means you need to go to either the 150 or the 155. Do you want to be able to make more and take in more credit? Then you have to go to the 155. Okay. So then sell the 155. Go ahead, hit next. This should give you around a 70-cent credit, $73 there. Go ahead, next. And this is probably going to free up some buying power because you're taking your strike further away from the current stock price. So go ahead and hit send and let that work. All right, you got filled. So go ahead now to your overview. Or I'm sorry, go back to your positions. Yeah. So now you probably have, you see how your capital that was being used was at like 73. Now it's at 77. So now you freed up some capital as well. All right. So we have earnings coming up. You can see the earnings now. All right. So today after the close, we have Microsoft, AMD, StarBucks, Pinterest. There's a lot of good stocks in here to trade. We have Boeing in the morning. What else? Those First Solar FSLR, that one that moves a lot. We're not going to trade that. But I like Starbucks. I like Microsoft's probably too big for you guys, but AMD, Boeing, and Pinterest. So go ahead and get Pinterest number one on your watch list because that's a stock in your price range, and then we'll look at Pinterest first. Yeah, pins. Sorry, PINS. Go ahead, add that to your watch list, and then open it up, and we'll take a look at it. It's $37 stock. We've got expected move of, what is that, $5 in the 3-day cycle. Okay. Go to the 3-day cycle, see what you got going on in here. $5 away. Where are your strikes $5 away? Be around 32 and a half. 32 and a half. That's the expected move. So go a little beyond the expected move. What do you got for 30? Not much. So go to the 31 strike, somewhere around there. If you were just sell the 31, gives you around 30 cents. I would go to the expected move, maybe even like just right at the expected move, because this is a pretty juicy premium in here. So go ahead and click the somewhere around there, whichever one of these strikes. How many delta does that give you? Long delta. So this is, you did the 32.5. So this is the 16 delta put right there. That's fine. Now you can choose to sell something on the upside as well, if you want, or you don't have to. Wow, you can get really far away. Go to 45, see what you get at 45. That puts you, what, $7 or $8 away? Maybe even the 36. I'm not sure I would be wanting to take. You could do 35. It's up to you. Do you want to lean bearish or bullish in here?
I don't know.
Okay. So then just do neutral. Look at the delta. That's around the same exact delta right there, the 45. And you just got filled in that other one too. Looks like you got filled in Neo.
Yeah, 45.
Yeah, sure. That would give you a completely neutral trade. Now look and see how much capital that's going to require. Remember, this is an earnings trade that expires this week. So you're taking in almost $100. What's the capital requirement? Or are you taking in over $100? Capital required is only $379. So this is a naked position. You didn't buy any of the wings. So you're taking undefined risk to both directions. Do you want to keep it undefined, or do you want to define your risk?
Right, just keep it like this.
Okay, well then hit send. You did not get filled. You did get filled. Did you get filled? I didn't hear it ding. There was no ding. All right. Do you want to look at, while that works, do you want to look at some other earnings trades? Abraham, you missed the earnings calendar. Am I showing my screen still?
Yeah.
Okay. Go to my screen, Abraham, and look at the earnings. What's coming up? We've got Pinterest, Boeing, what else? AMD and Starbucks. So go ahead. Let's look at Starbucks and AMD next. Whichever one you want to do first. The tickers are there. Can you read the tickers? No, AMD ticker is AMD. Starbucks is SBX or something like that. SBUX, I think it is.
Yeah.
Okay, AMD. So you've made $100 so far. And that Google position is really the only position that's really cost you money. You're down on that pretty decent, like $40, or maybe not quite that much. All right. So this one we're looking at, what does that say? 97 IV percentile. Okay, 60 raw IV. This is AMD. This is a relatively low price. Go ahead and look at AMD, the actual chart. I can bring up. I'll show an overlay of AMD, but we'll have to do that in post. All right. So AMD is really kind of been beat up here over the last. You can see, what's the time frame? How long is that? This is a weekly chart. All right. So like for months here, AMD peaked out way back up here at 227 and it's really been being destroyed. So go to your options chain. And then what is the expected move for the 3-day? It's 1250. Okay. So then that puts you basically $20 away, would be around the 120 strike in the 3-day. And then $10 away would be within the, what was the expected move? $12? Okay. I would have thought these would be juicier. So let's do $15 away. Does that look reasonable? $15 away. What's the delta on that? Huh?
14.
Why can I not see? It's not moving for me. Did you already look at the delta? What?
Looking at it right now.
Huh?
Looking at it right now.
Are you frozen? Jaden has started sharing screen. I can't see your screen anymore. Okay. All right. What's the delta on it? Now I can see it again. 16, 125, 13 delta. So you're looking at a 90, close to a 90% probability of success. What's the capital required to do this one? You're taking in $1.15 or so. Go ahead, hit next. See what the capital required is. It's probably going to be around 1,500, 1,200. Okay. All right, go back. If I were going to trade this one, I wouldn't be selling calls. I would only be selling this side, but it's up to you. You can sell both sides or one side.
I'm fine with just this side.
Just that side?
Mhm.
Do you want to do this or do you want to look at SBUX? Because you can't do probably all three.
I'm good with this.
Okay. So go ahead and put it on then. But when you go to hit next in this next screen, make sure, because this is not a spread, there's only one leg to this. What is it? It's trying to sell it for 115. Try and tick that up and we'll do a little price discovery. Try and do like 17, not 18. Go ahead and review. Send that. See, you would have got ripped off there. You got filled instantly at that price. You would have got ripped off. Oh, wow. You might have even been able to get more for it. Oh, well. Too late now. All right. So then we'll go over to Abraham. You've placed 2 trades now. So go back to your main profile or your positions tab. Now you've got a bunch of positions on. And you used probably another $1,500 in capital. So now you're at 50% of your capital being used at this, or not 50, that's a 6,000. You're still only at 40%. So, but this is a good place. You got a bunch of positions on. You adjusted PLTR. You opened a new pins position. Neo, you rolled your call out to the next monthly expiration cycle. Google, you bought back your 160 put and you rolled it out to the 155. Yes. Took in another 70 or so dollars in credit. Right? Did you get filled on that? Where's your new? Go back to it.
On Google.
Yeah. 155. Yep. Okay. And then AMD, you simply sold a put. Abraham, what does selling a put mean?
Is it buying an option?
Huh?
Isn't it buying an option to sell it later?
Selling a put is guaranteeing that you will buy it from somebody else later at that price. You're going to have to speak up.
Yeah.
Selling the put is guaranteeing that you will buy the stock at that price. You're just guaranteeing that if the stock goes below that price, you have to buy it for that price. Okay? If you buy the put, you're buying the option to sell it at that price. All right. So let's get your screen up here. All right. Let's get your positions tab open. We probably have to manage your positions too. All right. You have Neo. So let's do the same thing in Neo. Same thing that he did. We're going to buy back that call. And then we're going to roll out to the next monthly expiration. For the options. They also have a feature that allows you to just click a button to say roll, but I prefer doing it in here so you learn exactly what's actually happening and going on. So go to buy, click on the ask of your 10 or your 5 call. Yep. Then go collapse this expiration. Then go out to 52 day September monthly and sell the 5 call. Hit the bid. Yep. Then next. Should be able to do it for around 20 bucks. Go ahead, next. Go ahead and send it. You got filled. Okay. Now go back to your positions tab. Go to Rumble. This is the, what do you have? The 6 put still trading for, because this is such a low price stock, I say we just let that one go. It's only worth 35 cents. You sold it for, I think, around 30 cents to get it on. Worst case scenario is you take the stock and it's not going to cost that much capital. So go to SBUX. We're going to look at these earnings trades as well. SBUX, I think it is. Okay, let's see. This is 75% IV. It's not as volatile as AMD or pins. It's also really beat up. So I wouldn't be selling a call on this either. I would just simply be selling a put if I wanted to trade this. I like what you're looking at right here is the monthly expiration. There's an $8 expected move, and this is the September expiration. It's got earnings. Do you want to do the weekly, or do you want to go all the way out for a month?
Weekly.
Go to the weekly. 3 days left. It's a $5 expected move. Scroll up closer to. All right, so the 70 put would be at the money. What does the 68 give you? Anything? Gives you about 40 cents. I would sell, or not, I said at the money. The 70 put is not at the money. The 70 put is the expected move. I would just sell either the 69 or the 70 right around the expected move. And then scroll over, see how many delta that gives you. I'm imagining it's around a 16. That's a 19 delta. Okay. So you're getting long, basically the equivalent of 20 shares of the stock. You have about an 80% chance that this works. I wouldn't I wouldn't be on the other side of this. I wouldn't do the call side. I would just do the put, because this stock is, if you look at the chart, this stock is really beat up. Okay, go ahead and hit next. And that, what was the capital required for it? Around $1,000. Okay. It's around $1,000 to make up to 70. So go ahead, hit send it. Okay. Do you want to put on a trade in AMD as well? Or pins or Boeing? Look at Boeing. We haven't looked at Boeing yet.
What is it?
BA.
Honey. What?
Lay down. Go lay down, honey.
Yeah, right there.
All right, you got Boeing up. What's the expected move? Abraham, what's the expected move for Boeing? About $10. Let's round up to 10. It's 80. It's trading at 186. Are you in the 3-day cycle?
Mm-hmm.
Okay, so the 185 minus 10 would put you at 175. That's you can take in. This stock moves. I would be a little hesitant. It is on its lower end, but this. I don't know that I would. All right, let's go out to the monthly. Go out to the 50. Or first go to the August monthly, which is 17 days from now. It's saying a $14 expected move in here. So scroll down. Or yeah, scroll up rather. What do we have here? 60. Go to the monthly. The next month, the September expiration. What is that? A $20? That's not the next month. that's a weekly, bud. Yep. Okay. Look at these puts here. Go back, scroll back down a little bit here. Yeah. Okay. So what we're looking for here is a $10 wide situation where the cost of the lower, so basically look at the 155 and the 165. You see the cost of the 155 and the 165? They're about double one another, or half of one another. So you see how it's around a $1.05 or so, probably that would trade for. And then the 165 is 230 or so. They're almost half. We're looking for a situation where we can sell two to pay for one, if that makes sense. Does that make sense? All right, so get a little closer to the money. Let's do the 175. Buy the 175. That's a sell. Gotta hit the ask. Just click the ask. You can only do one or the other. And then do the 165, sell that. Now go up to where you're up top, where you see your two options there. Click on your sell. No, the other one. That's your buy. Put a 2 in there. That's 12. Hit done. So what we're doing here is we're going to buy the right to sell this stock at 175. And we're going to sell, we're guaranteeing that we will buy it at 165. So if we just did that 1-to-1, meaning we bought one and sold one, this would be a vertical put spread that we would be buying. But because we're going to do two, that means that this potential trade, if it were a vertical put spread, would cost us about what? What's the difference between these two? One, say 465 and what? 235. So the difference is about $2.30 or so, right? So that means you would be paying $2.30 to have the option of a $10 wide spread, which would, at most, if the stock goes down, this can be worth $10. If it's fully in the money at expiration, it'll have a value of $10, and you're buying it for around $2. Does that make sense? Do you know why it has a potential value of $10? Because what are we doing? We're buying the right to sell it for 175, right? And then we're guaranteeing someone else's right to sell it at 165, meaning we're buying it at 165. So if this stock is trading at 160 on the expiration here, and we own this vertical spread, it's worth $10 because you have the obligation to buy it at 165, but you have the right to sell it at 160 or 175. So if you can buy something at 165 and then turn around and sell it at 175, that means you made $10 minus whatever you paid for it. Buying it at 165, selling it at 175. But because we're doing two of them, we have to buy 200 shares, right? And we only have the right to sell 100 of them at 175. So that gives us a $10 buffer, where if it goes below this 165, where are we going to break even? Because for every dollar below that 165 that it goes, It's going to be eating into our $10 in profit that this one spread is going to make because we have an extra naked short put. Does that make any sense? So where is our break even on this going to be approximately?
55?
Go ahead and hit next. So this is saying we're doing this for the cost of the trade is $8. So this isn't quite a credit. This is a debit. Ideally, you'd want to do this for a credit. Go ahead and hit review. What is the cost on here? So 155. You see how the break even there at 155? Or where did you come up with that? Because you were right on it. How'd you come up with that?
You just subtracted 10.
Because it's able to move an extra $10 because you're making $10 in that spread, right? It's able to move $10 beyond your short strikes there that you're selling, because if it does move beyond that short strike that you're selling, then that spread will be worth its full value that it can be worth of $10. So that $10 then basically becomes a buffer to the downside before you start to lose money. So it puts you at 155. But we don't want to do this because in a good ratio spread, you're putting it on for a credit. Now, if we were able to take money in to do that, then you would want to do it. But there's not enough premium in here to contract to come out of this to make it worth that much capital. So go get out of here. We don't want to do this. Back. Honey, lay down. If you want to sell something cheap in here, you can sell maybe like the 150. If you want to just look at just selling a put, that would be an option. What's the capital required to sell that? You'd be selling that for around, what, 73 cents? Pick that up to 74. Hit review. What's the capital? $1,500 to make 70 cents. But remember, this is 50 days. You're using that $1,500 for 50 days, potentially more if the stock goes down. I don't like it. You can put it on if you want, but that's a lot of capital. You want to look at AMD or pins? It would be different if you were using $1,500 for $75 for the weekly expiration. That would be different because you're taking the position off much sooner. All right. What are you looking at now? AMD. Again, this one, same thing. Kind of bullish in here. You look like you're in the September expiration. You can trade the September or you can trade the weekly. It's up to you. Which do you want to trade? Do you want to do the September? Okay. So what strike do you want to? We're just going to sell a put in here. This is a really juicy stock. It's got earnings coming up. What strike do you want to sell? It's got about a $20 expected move over the next 50 days. That would put you around 120. You can sell the 115 for $2 in credit. You can sell the 120 for $3. You could sell the 130 if you wanted for $6 in credit. The 125, anywhere in between there. Or all the way down to the 110. Give yourself more room. The 125, okay, that's pretty bullish. Go see what your delta is. 23 delta. So you're getting long 23 delta in this. That means you have to buy this stock at $125 minus your credit, which is going to be, looks like 433 maybe. So you're really getting along the stock closer to 120, which, okay. It's going to be more capital intensive because you're closer to the money. Tick that up to around 134 or 133. Or 433, I'm sorry. Oh, it ticks in increments of... Click on the actual price. See if you can... There you go. See if it'll let you send it that way. Go hit review. And then $1,200. Yeah, like that. Go ahead. Send that. Oh, instantly filled. Okay. Oh, shoot. That thing is moving. What'd you get filled at? You got filled at 433. But look at that. It just... You probably could have got 440. Oh, well. Coulda, woulda, shoulda. Now, do you want to do something in pins? Huh? Yes? Pins? P-I-N-S? Jaden, what did you do in here? You sold the 3-day in here, right? I think you sold the 3-day. Are you still out in the monthly, Abraham? So the monthly, you can get really far away and collect a decent amount if you want. If you're going out 50 days, you could sell the 50 strike. Or the 48 strike. Or 47, 48. The 50 gives you what? You're taking 40 cents in credit. You want to take in around 50 cents if you're going to be... So if you sell the 48, that puts you what, $12 away? $11 away? I don't hate that. Around the 48, somewhere around there. You're on the call side, bud. You're on the puts. Yeah. What does that do? What are you agreeing to do if you sell that call? No. On the call side, you're agreeing to sell it for that price. So if it goes higher than that, you have to sell it at that price, which means if you have to go out and buy it at, say, 50 and then sell it at 48, you don't want it to go above that strike because you have to sell it for that price. Okay, and then go down to the puts. To the put side. Yeah, but we want to go scroll down in price. There you go. Remember the in the money and out of the money? We're selling out of the money. So on the call side, the out of the money is a higher price. On the put side, the out of the money is a lower price. So again, we want to take in around that 50 cents or more. That's going to put you basically at, yeah, it's going to put you around that 31 strike or the 32 strike. That's not going to put you really, really far away. You're only going about $6 away from the money, which is the expected move. So it's up to you what you want to do. You could sell the 31 or the 32. All right. What's the delta on that one? 13. Okay. What was the delta on your other one? Do you remember? Did you look? About the same. You're actually leaning a little short if you sell these, so that's fine. It's pretty delta neutral. You're only going to have like one delta in either direction. One short delta probably. So the whole thing's going on for $1.11, and it's going to cost you probably around $350 in capital. 380. Oh, I like that. Go ahead. Did it get filled? No ding. All right. It didn't get filled. Let's go ahead and tick it down. a penny. Let's see if you can get filled at 110. Cancel, replace. Review, resend it. There you go. Got filled. Do you guys have any questions about anything? Huh? No questions? Huh?
No.
Abraham?
Nope.
All right, that means that tomorrow morning, who's down $67 already? Is that your account, Abraham? AMD? That's yours, AMD. Oh, AMD just dropped $4. Okay. Dadgum.
I'm down more than that.
Yeah, I'm sure you're probably down close to 100. Yeah. Markets move. It's not going to... You have 50 days in your contract, so you have plenty of time. You have plenty of capital that you can keep this position on for a very long time. Worst case scenario, you end up getting long 100 shares and then you sell calls against your stock. All right. That concludes this. So you gave all your profits back already. You were up $100 starting the morning and now you're down. And then you also are down, Abraham. All right, that concludes episode 3 of Noob's News. Thanks for watching.
New but the knowledge, nobody does it better. Options game tight calls and puts. Stocks flipping quicker than they flipping the goods. E-trade dashboard, money to print. Boys learning well, following the blueprint. Noobs in the game, making gains. Papa showing hustle ain't just chasing chains. Trading like gangsters, setting the reins. Teaching them the street of ball and financial domains. Bull market, bear market, riding both tides. Papa got the boys all trading with pride. Short sell, long buy, never DeFi. Family hedge fund, fortunes can't hide. IPOs popping, reading the cues. Charts full of knowledge, breaking the news. Swing trading, day trading, grooving the moves. Shout out to the fan, puts of the trade ain't loose. Noobs in the game, making gains. Papa showing hustle ain't just chasing chains. Trading like gangsters, setting the reins. Teaching them the street of ball and financial domains.